CNBC-TV18 special in association with the Confederation of Indian Industry. I'm Shireen Bhan and we're coming to you live from Davos 2023. As we've been pointing out over the last 24 hours, the mood here, while continues to be somber, the world continues to deal with many of those persistent challenges that we were even talking about in May when we were here for the summer Davos. But the feeling is that perhaps on many fronts, the worst is behind us. When we talk about India, everyone is talking about India's resilience, and the question now is, can the resilience turn to resurgence? And that is the question we hope to answer and address with our panel here this evening. Joining me, Sanjiv Bajaj, TV Narendran, Rajiv Memani and Chandrajit Banerjee. Gentlemen, appreciate you joining us here on this CNBC-TV18 special. Here in Davos, let me start by talking to you about the global mood. Sanjiv Bajaj, you've been meeting with global leaders, global businessmen. What are they telling you? Are they expecting a recession, a mild recession, a long protracted recession? What's the mood?
Shireen, as you know, we're starting just today. So yes, we've met a few people. And as you started off saying, the general feeling is that the worst is over. There's always a caveat, right? Because we do live in very uncertain times. But currently it looks like the worst is over. And I believe that the world is divided into three pockets. You have the Western world, which is likely to go through a recession, hopefully a mild one. You have developing countries like China, like India, which are seeing a significant resurgence. And then you have China, which is just opening up and is already starting to create some positive movement. So a combination of this should be positive going forward.
Well, speaking of positive movement, China's reopening is certainly good as far as steel prices are concerned, commodity markets benefiting from that. Where do you see things headed, TV Narendran?
Yeah, I think China opening has certainly helped commodity prices. So not just steel, if you look at copper prices, it's gone up about $400-500 in the last month. Steel prices have gone up in China, domestic prices have gone up by about $100. So overall, we see a positive sentiment. Iron ore prices have gone up, coal prices have gone up. Not all of it is good for the steel industry, but overall the sentiment is changing in China certainly, and that has a huge impact in the world, as you know.
But do you expect these prices to be sustainable? What's the feedback that you're getting from the market?
Well, it looks like it will be sustainable for some time. The only spot of bother is, of course, Europe, where the demand is still very fragile. The US is quite okay, and Latin America is okay. China is looking good. India is looking great. So I think in many ways, many parts of the world are picking up where it left off over the last few months. So we are quite positive over the next 6 months.
Well, Rajiv Memani, as TV pointed out, it's different stories from different parts of the world. So there is this diversity that's adding to the mix as well. But higher interest rates, that's a given, and that's a certainty at this point in time. Easy money, no longer the era for that. That's a certainty, that's a given. What is that going to mean in terms of fund flows, in terms of M&A, in terms of FDI?
So you're absolutely right, Shireen. If you look at four big events that happened and things that normally drove growth in the past. So you had COVID, you had tapering, you had inflation, and you had geopolitical tensions that have come up. Historically, we have seen growth in the context of a stable world, a low interest regime, money flowing through. So these globalization, these were the big drivers for growth for economies around the world, and in particular for emerging economies like India and others. So I think we are going to see a new era that is going to come through. Also, I think the cycle, as Narendran was saying, the movement in which business is going to happen will be very rapid. So I don't think we're going to see cycles of year, 2 years, 3 years. There is going to be a very rapid turnaround. And at least what I'm seeing is that those and companies also, I mean, there is a lot of noise that Amazon has let go 10,000 people. But in the last 2 years, they've also hired 500,000 people. So, so I think there was an action that happened, especially in tech companies, and now they're letting some people go. So it's creating this thing. So as Sanjiv rightly said, there is a mild recession. Companies are getting prepared. And I think if your question is in reference to India, I think if I have to look at it, Middle East and India, and how Southeast Asia plays out and China plays out are seen as the positive parts of the world. So as long, I don't see, definitely, short-term capital will be more volatile, they'll come in, come out. But there are two big things that may happen. One is if Fed reduces. And a lot of times I think businesses are also, my personal view is that businesses are also talking of pressure and everything else. Because Fed has been very clear that they will wait for interest rate reduction once they see the labor supply tightening up. So I think Fed rate reduction and the Ukraine war, in my view, can't go on for another year. So as these things, settle down, these will be big
that
pops.
was the expectation last year as well. And here we are almost at the end of one year.
Yeah, but it's unlikely that both countries can sustain it for another year. So I think when these things change, I have a feeling that towards the second half of this year, we will see much accelerated flows. And I think India, given the GDP growth, given the tax buoyancy, given the macroeconomic situation, the demand and everything else, I think we are in a very good position to attract good flows globally, probably more in the second half than maybe in the first half.
Well, the sweet spot that you speak of as far as India is concerned, CB, let me get you to comment on that, because CI has just done your usual business confidence survey, and that tells you that at this point in time, the signals are pointing at a high as far as business confidence is concerned.
The business, as you said, the business confidence survey, the Outlook survey, in the last 2 years, we have never seen the index swing to the extent that it swung quarter by quarter. So it's something like an index of 67.56, which is over and above 62, which was in the last quarter, and the highest in 2 years. And we went a little deeper into it. We found that most of the PLI sectors, there is a feedback about adding on to capacity. And the capacity utilization is still around 75% in most sectors. And the expectation of growth, both in terms of the bottom line of companies, the corporate results, are pretty buoyant about it. And the outlook, if you look at the global outlook, as was said, that there is an expectancy of America bouncing back by the second half of the year. China, of course, the only laggard being Europe, being Europe. So there is a lot of optimism. The challenge only comes in export, but there is a lot of inflow coming with the interest arbitrage really going down between US and India. We see a lot of FIIs also portfolio investments coming in. So the outlook really looks into all of this and as a feedback, and therefore a very strong sort of a feedback from Indian businesses. And so probably a little bit, one looks at the budget much more expectantly, because there are a few things which can spur this optimism to a great extent if the budget is well received.
So that gives me the segue to come back to you, Sanjiv, with the priorities that you believe the budget needs to focus on. What are those 2 or 3 things that you hope that the budget will deliver on to try and move from resilience to resurgence?
Very clearly, the first should be a continued expansion in the government infrastructure funding. We have seen that this has played a very positive role the last few years. It's held our economy together, it's provided rural and urban jobs, and created that much more domestic consumption. So we hope, like the 25% increase last year for public infra spending, we get to see that as well. The second is that this current period really hurts people at the lowest income of society the most. And inflation has hurt them, loss of jobs has hurt them, especially in the informal sector. And hence, a cut in personal income tax only at the lower segment, we believe will help these people stretch their rupee a little bit more. We think the PLI schemes, as CB just said, have been very positive, extending that and adding a few sectors towards what we suggest as an employment-linked incentive scheme for sectors like logistics, tourism, which take a lot of people. This can again provide great fillip. So essentially, productive use of the capital for greater jobs and more consumption.
I'll come to consumption in just a second, but let me get the taxman on the panel into the conversation. A cut in personal income tax at the lower end is what CII is suggesting. Oxfam has put out a report, as they usually do at this time of the year, and once again, it highlights the widening inequality and the gap between the rich and the poor. And Oxfam is suggesting that, at least as far as the Indian government is concerned, they should tax the rich more. Rajiv Memani, that usually is the expectation around the budget. Do you believe that we're likely to see some changes there? And even on the much talked about capital gains tax, do you believe that we are going to see some move towards parity across different asset classes?
Yeah. So I think the maximum marginal rate of tax in India is 43%. in most countries in the world, it is there or thereabouts. In some countries, it probably reaches 45-50%. But the benefits that they enjoy in terms of education, healthcare, and everything makes up for the difference. So I would think that I don't anticipate, the government to be raising taxes. I think the tax revenue collection has been quite buoyant. I think India, we should be doing about almost 30 trillion. So almost 16-17% growth in tax, which will be equal to the nominal growth. It would have been higher, but because of the reduction in excise, the number is slightly lower. Otherwise, we should have seen tax buoyancy. And I think capital gains, in my view, is more of a simplification process. It's not so much to say that you can get more revenues here or you can get more revenues there. I think the government has done a very good job till now, and compliments to them, that they have kept a very steady regime. So, things haven't changed. I think the radical change that we saw was the reduction in corporate tax rates. And I think that's playing out very well. Hopefully, the private investment cycle starts to validate that decision that was taken. Where I see, Shireen, that biggest change where the government needs to make is really on the dispute resolution side. So simplification in terms of capital gains in TDS. We have 31 sections that deal with TDS. There are 36 different types of payments that are covered. There are rates ranging from 0.1% to 30%. Massive disputes. So I personally think the one big focus area, again to attract capital, to make it easy for doing business, is to look at simplification. There is far too much of litigation. So how government does alternate dispute resolution, or in my view, even if they can't come to an easy answer now, doing a VSV scheme. Vivad se Vishwas, something on those lines, I think will go, because that is today the biggest issue that people are facing, is that dispute, the tenure of dispute is just going longer and longer and longer.
Well, we've been reporting on this, that this is likely to be something that the government is considering. Whether or not it comes into the budget or not, we don't know, but it certainly is something, another scheme that takes into consideration the litigation that you speak of is certainly under consideration at this point in time, but we'll have to wait to see. When we were here in May, that is when the government decided to bring in export taxes. The industry was of the view that if you really want to encourage private investment, especially in long gestation sectors like steel, etc., then that was a bad idea. Now that it has been unwound, what is the situation as far as further investments are concerned, not just for steel, but what's the indication that you get on private capex? Are we finally going to see it take off?
Yeah, I think, that certainly hurt the sentiment for the steel industry, which to me was ahead of everybody else in announcing capex for growth. But it's going to come back, because once the demand grows and we are allowed to export. And there's no reason why India shouldn't be a big exporter of steel. India has the raw materials, and why should Japan, China, and Korea be exporting steel when they don't have the iron ore and we have the raw material, and we should be exporting steel, creating jobs. The second part is, yes, when I look at our customer segments, if you look at automotive, they are back to where they were 4 years back. If you look at construction, it's quite strong. Industrial buildings, a lot of investments going on in supply chains, warehousing, a lot of investments in oil and gas. So all that will trigger private sector investment. So I think we are probably 6 months to 1 year away from getting private sector investment back the way it should have been.
Didn't I hear all of you say that 6 months ago as well?
For the steel industry, we had to take a 6-month break.
Yes, you did.
Yeah,
yes, you did.
But still, if you look at Tata Steel, we are spending almost 10,000 crores a year on capex, and most of our peers are doing that as well. So the steel industry is spending that. I think chemicals was also strong. They should be coming back, and I think there will be a lot of investments in supply chains, because a lot of money is going in there. Logistics and infrastructure is another area. So I'm quite positive.
Okay. But speaking of positive, Sanjiv Bajaj, let's talk about the consumption story. As far as the banking sector was concerned, and NBFCs, this has been, 2022 was a great year in terms of earnings as well as in terms of credit growth. Do you believe that that's likely to continue at this point in time? Because that's where the market seems to have some questions in trying to link valuations to performance.
Yes, so I'm not an expert on the markets, but I can tell you this, that from FY22, if you look at banks, if you look at the stronger NBFCs, they're very well capitalized. Their loss ratios are at their lowest ever. Credit growth, if you see, has been strong now. It's in the mid to late teens. And from everything we are seeing on the consumption side, last year, towards the end of last year, we saw a rural consumption dip, but that started picking up again. Urban consumption is a little choppy. We see some months where it's growing strongly, other months is a little flattish. But all in all, overall, there is clear growth. And hopefully with China now opening up, the supply chain disruptions will go away, which will make a very big difference as well. The government continues to support people at the lower income as well. So combination of these factors should continue with stable to, I would say, growing consumption on consumer durables and other items, which should keep the capex cycle going.
Okay, and you believe you'll be able to replicate the 22 kind of numbers?
Well, I wouldn't project out numbers right now for any particular company, but I would say overall from an industry perspective, it does look reasonably good. A lot again depends on external the situation. There are uncertainties, and this could play spoil sport. I think the first 2 quarters could be a little muted, but of the new year that is, but thereafter should be good.